Welcome to the inner sanctum of New View Trust. Yes, this is where we work every day to keep everybody's accounts safe. But in addition to that, give them lots of opportunities. So I'm really excited to go over this particular discussion. My name is Glenn Mather. I'm the founder. I've been here 20 years helping people unlock their IRAs and get the kind of freedom. But I've got to tell you something, when you have IRAs, we'll talk a little bit about what we do. Nothing says freedom like conversion. And we're going to explain a little bit what that is. But first, just a few little backgrounds about what we do. First of all, you'll be glad to know I'm not an attorney. I'm not a CPA. I'm not a tax professional. Where we go deep in here at New View is to understand what's capable inside IRAs. So many people kind of think that IRAs themselves are a particular type of IRA, and it's really not, because they're structured all the same. The difference is the freedom that you have within each one of these accounts. So whether you have a traditional, a Roth, a simple, a SEP, even when you have a solo 401k plan, those structures are all the same, the rules are all the same. What's different are the custodians and how they apply their individual rules and their individual limitations on you, which is what the market generally does. And why I created this company 20 years ago is I was tired of what I was getting in the marketplace, which was basically stocks, bonds, and mutual funds. And I felt like all the opportunity was taken before I got in line. The stock market's a really great place to invest, but understand that you're always paying full market price for it, because you've got millions of buyers and millions of sellers that are on this marketplace together. Whether you're on a Charles Schwab account and you're looking at their numbers, those numbers are based on millions of transactions that are going on in these stocks that you're interested in. So guess who has all that information ahead of you? Well, the people that study this, the people that spend all day looking at this. So what you have to do is you have to buy an investment and then wait for it to go up. What's really, really exciting about self-directed investing is the fact that you may be able to buy it under market because you're not bidding with everybody else out there. You have your own lane and you get to play in your lane and you get to invest in things that you know and understand. And quite frankly, most of what we invest in the marketplace, we don't know that much about. So self-direction, I just think, gives you freedom. And freedom can be good, freedom can be bad, right? You can, if you extend all the different types of things you can invest in, you may not pick things that you know and understand. So the fact is that because you have the choice doesn't guarantee you success. But what it does is get you opportunity for success. And some people like the self-direction because it gives them an ability to diversify what they're doing. We talk about that in the stock market all the time, but it also is in true self-direction, because I can buy single family homes, rentals, I can lend money, I can invest in new startup companies, all within my same account, which is really, really cool. Now, of course, tax savings are the basis of why you have an IRA. That's the real benefit. And IRAs were created when companies they actually petitioned Congress to say, hey, we can't be competitive with Japan. First was Japan and then worldwide if we have to fund these pensions for our employees. So with Congress's help, they created these types of accounts. First it was IRAs and then 401ks, 403bs, 457 plans. They created these so that the companies wouldn't have to have this huge load of having to pay retired workers. And especially since we all, hallelujah, we get to live longer, it means the companies had to keep paying and paying and paying. So nowadays, it's pretty much up to us to decide how we're going to retire. Of course, the first part of that is savings, but the equal partner of savings is investments and what to do. And so this gives you an opportunity. I found my very first investment I did in my self-directed IRA was a piece of real estate. It was a lot near Charleston, South Carolina, near the beach. I love the community. We went there all the time as family. But I couldn't afford a house there, but I had enough money in my IRA to buy a lot. And I bought it for about $100,000 and I watched it go all the way up to $248,000. And that's all in a tax-free account. I got to figure out this is pretty powerful. I'll bet there's gonna be a lot of people in Florida who want to do the same thing. And sure enough, 20 years later, thousands of accounts, billions of dollars there on our platform, and now people are really showing the excitement about this. Now, we're in a tricky time right now as far as the economy, and depending on whether you're viewing this live or viewing this recorded, of course, things change all the time. But there's opportunities for self-direction, whether the stock market is red hot, whether it's starting to go sideways, or whether it's in free fall. Those opportunities exist, but you can only access them if you have a self-directed account. So this is just a little bit of a background on what we do. Here's a listing of some of the things that we do. Foreclosures, and foreclosures are really an ugly side of a bad economy. And we haven't had much of those lately, but people forecast that those opportunities are just ahead of us. And it really depends on whether people can afford their homes. The last time in 2006, 2007, 2008, and then several years after, because it took a long time for us to recover, lots of foreclosures were out there. People were kind of nudged into just doing strategic foreclosures. Why pay for a house that is going down in value? So whatever the moral segment of that is, that's what a lot of people did. And so a lot of people were able to pick up those houses at a very low rate inside their self-directed IRA accounts and be able to make money from them. They may still be holding them today. Tax liens are interesting. Almost every state has tax liens, and it's usually in Florida, it's county by county, and you can earn up to 18% on those tax liens. There's rules and regulations around it. There's experts that do it. Just like everything in our capabilities, we allow everything that the IRS doesn't prohibit. And certainly tax liens are something that some of our clients do. Apartment complexes, they tend to be somewhat protected against the swings up and down, because this is where people live that choose not to buy a home or may not be able to afford a home. And we've seen more apartments go up here in Central Florida, and probably where you live too, because people aren't able to afford homes. So this is where they're going to be living. So this is investments you can do. You can do it in a syndication, meaning you own one small part of it, or perhaps you can put together your own syndication and bring other people's IRAs to play. I always thought, apartments, that's for the big money guys, but apartments can be as little as 5 or 6 units that are tied together. So that's interesting. Real estate options are, it's not just purchasing, but you can actually put an option down on a piece of property and buy that in your IRA. Of course, condominiums would have the same rules as a single family home. Unimproved land, that was my very first purchase. I love buying unimproved land. The only thing is, remember that you have to pay tax on the unimproved land, and that would come out of your IRA because your IRA owns it. So make sure that you have the longevity and understand that, and that you're making at least more in the improved assessed value of that property than you're paying taxes. Commercial property of all types and not listed on here are startup businesses that you can also invest in. I wanted to make sure that not everybody that's watching this or listening to this today understands anything about self-direction. The rest of you are saying, get on with the topic, get on with the topic. I thought we were here to talk conversions. But understand, I don't want to leave any investor behind. So we just have to give a little bit of background on that at all right? And there's promissory notes, and this is kind of a hidden gem in self-direction. We have so many of our clients that actually create notes. There is a note here that you see, the unsecured note. I kind of like the icon there showing the unlocked lock. That's how I view unsecured notes, although they're perfectly legal to do. Obviously, if your IRA lends somebody money and they don't pay back, certainly your IRA can obtain a lawyer and go after the individual, but it's so much easier just to foreclose on the property that was in the original security agreement. So just because I don't recommend it or other people don't recommend it, it is something that you're allowed to do inside an IRA. Joint ventures, limited partnerships, limited liability companies, trust, all of these are interesting. The one that interests me the most on this list is joint ventures, because the power that it gives you to be able to partner up with 1 or 2 or 3 more individuals and bring your own skills to the party. So if I could actually have an IRA, a very little IRA, or I could have a large IRA and meet someone, let's say I have a larger IRA and meet someone that's really good at real estate, I can have that individual find the property for me, and we enter a joint venture that says they'll fix it up, and then we'll sell it and split the proceeds. However, all that's written up It can be very, very simple in 2 or 3 sentences, or it can be very complex where you hire a lawyer, the IRA would hire a lawyer and actually put it out in process. What happens over time is you have to follow the steps in that joint venture. And at the very end, the monies are dispersed according to the terms of the joint venture. It's pretty interesting. Sounds complex. I'm actually surprised that more people don't do this because it's a powerful process. If I don't have a lot of money, there's a way for me to get a lot of money into my IRA through that process. Okay. Well, there's lots of different types of plans, and there's 4 types of IRAs. We'll separate them into 2. One is a personal, which is the traditional and the Roth. It's basically you fund it with any earnings that you had, any earned income, not investment income, but you're allowed to put money in. I believe it's $6,500 this year, and an extra $1,000 if you're old and ancient like me. Over 50, you get the extra $1,000. But that's how much you can put in. Most people actually don't fund their traditional IRA with those smaller amounts. They actually fund them through rolling over their employer plan. So all the 401ks, 403bs, 457 plans, they typically do not stay in those plans once the individual retires or leaves that employer. They're rolled over. They can be rolled over 2 different ways. They can roll it over to their new employer's plan, which is a terrible idea because it's very restrictive, or they can roll it into an IRA, which can be a good idea, especially if it's with NewView, because then you'll have all the choices. Whereas if you go to a traditional brokerage house, it's just the stuff that's available in the stock market. That's all you can do. So these are the 2 kind of plans that are called personal plans. And there's actually a couple of plans here that are called employer plans. The SEP and the simple IRA, we're not going to steal too much more thunder from why we're here, but understand those plans are available. There's a Roth 401k, which is, quite frankly, it's in a 401k. You get to choose whether you want to do it pre-tax in the case of a traditional 401k or a Roth IRA post-tax. They're still all IRAs. These are all the opportunities you have. So we can start in all of these plans. There's health savings plans and Coverdales. These are not eligible for Roths, but these are just other ways that you can actually save without paying taxes. And if you have want any more knowledge about the basics of IRAs, we have many other videos that you'll be able to see and podcasts that you'll be able to see. But here's the biggest difference. One is pre-tax and one is post-tax. Now, it seems to me that I would never want to pay tax voluntarily. Today, that's all we're talking about is voluntarily paying tax. And you're going to pay the tax because you want to get the big advantage afterwards, all right? So quite frankly, this is really the benefit of having a Roth IRA. And to me, it's psychological. I am a bit beyond 50. I won't tell you exactly how far beyond 50 I am, but I'm beyond 50. And when you get beyond 50, you start thinking about the fact that your life ahead, if you're fortunate enough to be able to retire, is now a lot more about thinking about your retirement than thinking about your career, your job, what you're doing here. And the closer you get into your 60s, now you're obsessed by all of that kind of stuff. The one thing that I've told that people that have Roths versus don't have Roths is this. You hate paying taxes even more when you're no longer earning any money. So it's easy when you are employed by an employer and they take the money out of your check. Yes, instead of getting $2,000 a week, you're only getting $100 or $1,500 a week. I understand that. But that tax is being withheld and paid to the IRS on your behalf. You don't feel it as much if you never see it. Mm-hmm. When you're retired, can you imagine, let's say that you need $50,000, $60,000 to live on. That means you have to go get $80,000 from your IRA, write a check for $75,000, write a check for $10,000, $15,000 to the IRS to get the rest of the money. I don't want to do that. Mm-hmm. People in a Roth don't have to do that. Because of this. Because if you had a Roth IRA for 5 years and you've achieved the grand old age of 59 and a half, but both those things have to be in place, you can take distributions, all of the money out of your Roth at any time with no taxation. No taxation. All you do is pay the tax in advance when you put the contribution in. That's a game changer. It's a game changer even at my age. I have an IRA that's in a Roth. I have an IRA, some IRAs that aren't in Roth, and we're going to talk about that conversion process. But understand, I love my Roth because there's another huge benefit of it. I'm not told that I have to take it out. The Roth can remain with me the rest of my life. It can get bigger and bigger and bigger and bigger. And I will tell you right now, it's going to be the last thing that I take out. Because that piece of an IRA that I have outside the Roth, all of a sudden at age 73, I have to start taking it out. They force it out based on my age each year. They force out more and more and more and more. What if I don't want to take it out? What if I want to save it for my older age? I can't do it. I have to take it out. The IRS wants those taxes paid by me, so they force it to take it out. So it's a huge deal. The older you get, it is true that you might scratch your head about whether you want to convert now. The best time to convert, of course, is when you're younger. Best thing of all is put all your money in a Roth now. But not all of us are young enough for that. And some of us may make too much money to be able to do that. Okay? I'll put my glasses on so I can see a little bit. So how is it going to affect you? Well, conversions are part of your adjusted gross income. And what this means is if you're going to convert a traditional where I'm going to have to take the R&Ds and I'm going to pay the tax when I get older and take it out, if I want to get that all changed to a Roth where I don't have to take it out, don't have to take R&Ds, I'm going to have to pay now. I have to pay the tax now. People call it paying tax on the seed, but not on the harvest. When you're harvesting the apples, you just paid for the seed. And that's what's happening. So anytime you decide to do this, this is tough because what happens if, let's use $100,000. Let's assume that I'm 50 years old and I like that. I saw Glenn and I thought about this and I said, I love real estate and I'm getting a heck of a deal on this. What if I pay the tax now? Well, it's going to bump you up $100,000, right? And as Tabitha's here in the audience, and she just pointed out before we started, when we were discussing it, she said, well, one of the best times to do it is when you have a bad year. I go, what do you mean have it? Well, you have a bad year as far as taxes go. You have a very low year. Actually, it's a good year for you, but a bad year for taxes, meaning you have losses. And when you have losses, you might be between jobs. You might be on maternity leave. You might have all sorts of reasons why maybe this post-COVID hasn't really been good to you and your income. You've been unemployed. What a great time to take a Roth and convert it to a Roth. They start a 5-year clock. Now, we haven't talked about the 5-year clock other than I said earlier that you have to have a Roth funded for 5 years before you can take the money out without the 10% penalty. All right. So if I started a Roth at 60, I'm beyond the years, the 59 and a half, but I still got to wait 5 years. So the one thing, if you're watching this, the one thing you want to do is start a Roth right away, and you don't have to fully fund it. Put $5,000, $10,000 in it and start the clock. That's extremely valuable. Plus, you're not going to be taxed much on $5,000 to $10,000. And then in that bigger year, you can start socking it away. All right. The nice thing is, and you'll see an example if we have time to cover that, is that your Roth can partner with your non-Roth. So your traditional and your Roth can buy the same asset. It's just going to take ownership in the percentage of the funds that go into that investment together. So this is really important to talk to your tax advisor about the best timing on this, but what it's really your choice. I love the fact that I have so much funds in a high percentage of my funds in a Roth because I don't stress about it anymore. I know that I can be able to take 100% of it out. I can actually take it all out right now, which is really cool. So is it you? Is this good for you? Wow, this is really, really hard. It depends on how you look at the world and how successful you're going to be, how much money you're going to have in your IRA, who here can predict what you're going to be doing at 70, unless you're 71, you could probably have a pretty good shot at it then. But until you get into those decades where you're going to be relying on your retirement or not relying on your retirement, how are you going to know? So what you have to do is stack the deck in your favor. How valuable is having untaxed income in the future? I've always been shocked that the Roth hasn't gone away. It's not particularly good for the government not to give me that kind of freedom, not to give me that kind of freedom in a self-directed IRA where I can choose what I can do. I can find stuff on sale and bake that in And guess what? They got me once on the converted amount on taxes, but they're never going to get me again on the big amount. So I still convert. At my age, I still convert. Not a lot, but I convert, and I'll take a look at what my estimated earnings are, and I'll make a determination based on, is this going to kick me into a higher bracket? What is the cost going to be? And if it's going to cost the top bracket, which I believe is 37% this year, probably not. But what if I'm in the 22% bracket? Maybe that might be good. So this is a personal choice, and there is no guideline except this. If you expect to have low income in your outer years, don't convert. Doesn't make sense, because the tax that you're going to be paying on traditional is not going to be very high, because you're not. But if you're thinking that success, and maybe you have other income coming in, I mean, understand that you don't have to invest only with your Roth or your IRA or 401k. There's other types of investments you may be in that may be kicking you up into higher brackets. So the one thing I will tell you for sure is that if you're retiring in 5, 10, 15 years, the tax brackets will be higher than they are now. We cannot run the government with our tax base. We know what the deficit looks like, and sooner or later, there's going to be pressure. And when they come after the millionaires, then they start coming after the $250,000 payer, and they're going to have to come down to get that broader sense of the taxpayer. And so it's kind of nice when you're in that retired position to have as much converted as you can. So you can do all the math, and there's lots of places to go online. Should I convert my IRA? Certainly go take to a Roth. Take a look at that and see if it makes sense for you. Talk to your tax professional. But I think that depending on how good an investor you are, will push you further and further into the Roth. So we talked about the marginal tax bracket. And what about your beneficiaries? I kind of like the fact that, what if we're really successful? What if we have $500,000 in our Roth and we pass away? Well, what's really cool about that, generally speaking, the spouse can take that over as their own and take distributions over their lifetime. Your children or your other beneficiaries generally have to take it over 10 years. But keep in mind, they get it tax-free too. So all of those tax-free benefits don't end when you die, they continue with your heirs, which is really an amazing thing. So you don't have to scramble and take it all out in your later years of life. So lots of good positive things to do. Yeah, I mean, there's a lot of rumors around that you might make too much money to do a Roth conversion. And that's interesting, because there used to be income limits on it. And it's been about 10 years when that rule has changed. Bottom line is this: no matter how much money you make, you can be a millionaire or not, you can still do conversions. There's no income limit for that. So I love the fact that that's changed. There's also another way to get, what about getting money into an IRA? We talked about converting it. You can also put money into an IRA through the backdoor Roth IRA. And the backdoor Roth IRA is really this, and I'm see if there's a slide particularly on it. There isn't, so I'll talk about it now. If you have a certain income level, over a certain income level, and it changes every year, you are not allowed to have a Roth IRA. You can't put money in a Roth IRA. And here it is right here. 153 for a single, and if married and jointly, filing $218,000. Well, you go, that's frustrating. Well, the good news is you don't have to be frustrated, because it's just a two-step process instead of one. Contribute to a non-deductible traditional IRA. In other words, you're going to pay after-tax money with that. And you go, Glenn, why would I do that? Well, the easy thing is if you do that, you simply convert it at no cost. So if I put 65, I can actually put $7,500 into my traditional, because I'm allowed to do it. And with my earnings, I can do it. And then the next day, I just simply convert it to a Roth with the paperwork. No cost, no obligation. If you have two accounts with us, there's no change. There's no change in fees. There's no cost to do it. It's really cool. So we have clients that do this every year. So that's a way to get money in. That's not converting. Well, the second part's converting, but it'll convert at no cost, because you didn't take the tax benefit when you contributed in the first place. We said that before, there's no income limit, but it's certainly worth saying that again. We'll play out a little bit of a case study. Now, it's funny, we have a lot of case studies on real estate. Real estate prices go up and they go down. I remember in 2004, 2005, it's interesting, we were in this business for about 3 years. The mean price of a home in Central Florida was $255,000. And we watched it get cut in half in 06 and 07. And it took almost 10 years to bring that back. So real estate, everybody that I talk to, especially young people, say it's unaffordable now. It's really difficult. And then I looked at the apartment costs where my daughter was staying. I go, man, for that, you can buy a house. And then I realized you couldn't buy a house because the houses have just outpaced it. So real estate does go in waves. It doesn't stay up forever. We don't know, depending on where you are. And real estate is not national, it's local. So different markets change. So don't pay attention or say, this didn't happen. Actually, these case studies actually happened within our own files, so we pull them out. And this is what happened. So they did a conversion back in January of 2011. They did 150,000, and we assumed that we didn't know what their tax bracket is. We don't know that as their custodian. And they paid, if they're in that bracket, they paid $49,000. But they took that converted IRA that was in a Roth, they purchased a home for $101,000 and rehabbed it. So they're in $131,000 and they sold it for $239,000. So they had some holding costs, taxes, and insurance, but they netted $94,000. So that's a pretty good way to do it. That's just one transaction they did. So they covered their tax hit with one transaction. Is this unusual? Well, it's not typical. Not everybody makes these deals and finds them. However, what happens is when they have a self-directed IRA, they tend to be looking a lot more, and they have a lot of friends, and they network, and just like our clients do. And they find people that have the ability to understand real estate. A lot of times, those joint ventures that I talked to you about earlier, they're accessible to you. And it's really, really cool when you do them in a Roth IRA, because that's the accounts you want to get bigger. There's no doubt about it. So they did over $650,000 in 5 transactions that they did inside their IRA. Well, can I convert assets to a Roth or only cash? And you can actually, as long as you get a fair market value by a third-party assessment, you can actually move. You could move a property that you currently own in a traditional into a Roth. That's perfectly fine. You just got to establish what the valuation is. And you got to be willing to pay the taxes, of course. So here's another case study. I kind of like this one because it highlights a fact here that I mentioned earlier. So here you have is Bob Smith. Bob Smith is not completely convinced or that now is the time to convert all of his IRA. So he's going to do part of it. So he sets up a Roth IRA account, converts some over, and he goes and purchases property. So one thing that you may not know, if you've never done a deal inside a self-directed IRA, titling is everything. So here's how it's titled. So his purchase was New View Trust Company, FBO Bob Smith. Here's his traditional IRA number. And he says 50% of it belongs to my traditional IRA. And you can't read it because it's in blue print, but it says New View Trust Company, FBO. That stands for the benefit of. After all, we're a trust company and you actually have a trust inside your IRA. His Roth IRA is also owning 50%. So everybody that touches that paper and touches the document understands, including our people when they're booking revenues from the rental income, they understand that that check, whatever that rental check that comes from the tenant, 50% of it gets posted to the traditional, 50% of it gets posted to the Roth. That's pretty interesting. So he paid $330,000 in 2009. Oh man, would I wish that I could turn back the clock to 2009 and start buying real estate again. It's funny when we look at real estate, it could be that we turn back and look at, wow, it only costs $200 a square foot, only $250, it's $500 now. I go to, my friend lives in California and I go out there, they're paying like $600, $700 a square foot for their properties. So you never know where these are gonna go, but if you want to act on them, this is one way you can do it, by splitting the investments. So they want to pass it. This is a little more complicated because they want to pass on the assets in a beneficial Roth, a beneficiary Roth, and they're able to do this. And there's just so many different ways to deal with the conversion. I would suggest all of you to at least do some. Open the account because it allows you to do the conversion. If you're doing complex, I don't want to say complex deals, this isn't so complex. But if we go into our company vaults, the thousands of clients we have, I would say that probably 10 to 15% are partner deals, many times through spouses. And you go, well, Glenn, are you allowed to do that? Well, you're allowed to partner. You're not allowed to commingle. It doesn't all go in one pot and it gets mixed up. The wife and the husband, the money that they invest in them, the properties have to stay titled individually to them through their IRA as to the percentage that they own. Whatever they put in, they will get out that same percentage. Just reminding you on real estate, when you buy real estate in a self-directed IRA, it means all the revenues belong to
the IRA.
Which means that all the funds are sent to NewView, who hold your IRA. So the tenant has to make their check payable here or transfer the funds here, and then all the repairs, Tabitha, who pays for the repairs?
Your IRA.
Your IRA does, right? So that's what our administrators do here to make sure it stays in an IRA. So there is a texting thing if you want to get started, or if you don't want to get started but just need to kind of figure out more things to do. I'm going to open it up for questions. Is there any questions in the audience?
Yes. When is the best time, or no? Can I do a Roth conversion when I'm holding a property and then take it as a distribution?
Oh, can I expand on that a little bit? I'm glad you brought that up, because the whole concept of self-direction gives you so many opportunities to do unique things like you mentioned, but you only mentioned one piece of it. I tell realtors this all the time, brokers, anyone that's selling anything, especially here in Florida, because it's such a vacation-oriented state, but it wouldn't matter wherever you are living, is that as you start getting to 40 to 50, maybe even to 60, you can use a Roth IRA in a very unique way. You can actually find the place that you want to retire to and buy it in your Roth IRA. Well, what difference does that make? Well, about an hour away from me starts the Florida coast. So if I can go to the Atlantic coast, Atlantic Ocean coast, and that's Ponce Inlet, it's New Smyrna Beach, it's Cocoa Beach, all of those places that many of you have heard of that are watching that. Maybe it's your dream, either to live on the beach or near the beach, where I can just put on the flip-flops, and that is a dream. And if it's not your dream, it may be your spouse's dream. Well, why not start working on that with your self-directed Roth IRA? You say, well, Glenn, why is that important? Well, if you recall, and it was a little bit seated in that question, as you recall, that when I take a distribution and I'm at least 59 and a half and have held it 5 years, there's no cost. So what if I was to find a place, a home, save up some IRA money, convert it, and buy that property that I always wanted with my retirement plan? I see people here all the time that have large retirement plans because they got them from their employer. They may have worked at the same employer for 30 or 40 years or transferred it from employer to employer. All of a sudden, they're sitting on $700,000, $800,000, $900,000. If they're not, combined with their spouse, they are. They have a lot of money. And for many Americans, that's where their wealth is. It's in their IRA retirement plan. What if I could actually plan my retirement when I'm 45? So I go buy that house in New Smyrna Beach and I put it in the rental pool, right? There's not too many places that go empty, I will tell you, as an owner of a property near the beach, that they're never empty. And if they're empty, all you have to do is adjust the rent. It will start coming in, and over the course of time, it's going to go up. And now all of a sudden, because of changes in what I'm doing, what I'm earning, I could possibly go live anywhere. And we certainly learned that with COVID, that we can live anywhere and still work for many, many companies. All of a sudden, I'm scratching my head. I'm working for an employer I don't really like. I've got enough saved. What about that beach? Well, at any point in time, after 59 and a half, I can go take it as a full distribution and pay no taxes. It's now my house. And all that cash that I've been getting year after year after year with all the rental costs, I can use that too, because it's in my Roth account. That's stunning that most realtors don't understand that, because the amount of money, I think it's over $12 trillion, is in IRAs. Why wouldn't you go get it and use it? The only thing that I always felt that I have a chance on when I invested was real estate, because it was a thing that I could study and understand. Remember, we talked about that earlier. So thank you for bringing that up. Yes, you can take a distribution of the property because it is an IRA asset in a Roth, and because you can take it out, you simply take it out and transfer the title from New View Trust for the benefit of Tabitha's IRA, Roth IRA. It now is just Tabitha's house.
But before I take it as a distribution, I want to be able to live in it.
No, because that's the longer version of what you can do in IRAs, and we didn't touch on that. Yeah, you're a disqualified party. So as a disqualified party, you're not allowed to use or get a benefit or give a benefit to your IRA. So that would legally keep you out of that condo until you're able to retire. It's funny you brought that up, because I got used to, early on in this business, I would get calls from Miami all the time, and it was the 305 area code, so I knew it was Miami. And someone would come online and say, hey, I heard I could buy my condo that I stay in every year in my IRA. And you always like to say yes, you don't like to say no. So I would immediately say, why would you want to buy it in your IRA? Well, it keeps going up. It was lower last year, and I got the little real estate flyer, it keeps going up. I know what I'm paying goes up. I just want to do that in my IRA. I said, perfect, you should, but it can't be the unit you live in or stay in. Just buy the one next door to you. It's got the same wicker furniture. It's got the same view. Why not buy that? And they go, oh, because your IRA is not supposed to benefit you right now. It's supposed to benefit you later, right? Just like the Roth isn't supposed to benefit you right now. But if you're 59 and a half, or going to be 59 and a half in 5 years, 5 years later, you'll get the full benefit of your Roth.
And is there a limit on how much I can do at one time for a conversion?
No, you can convert it all as long as you're willing to take the tax paying. So yeah, obviously the larger the conversion you do, the more taxable, event you have. And if you have a large loss, convert it all. But I would definitely put it just as sort of like exercising, on a routine basis. Make sure you exercise your choice on a Roth conversion every year. Make sure that you understand that you do that. You have to do it within if you do it within anywhere from January to December, you won't have to pay that conversion tax until the first personal filing deadline, which is April the 15th of the following year. So it doesn't come due right away.
And when doing the Roth conversion, I would add the money that I'm converting to my earned income for the year.
That's right. It just goes on top. Not just your earned income, your total income.
Total.
Modified adjusted gross income. So that would include all your investment, whatever other investment income that you would have. Yeah. So it just gets stacked on top. That's what you call the marginal rate. So that's the effective rate that you're paying on that additional. So if there's no other questions, I've really enjoyed the time. This is one of my favorite subjects. I hope that you text to that, get more information about how this works for you. You may already be a New View client and want a Roth conversion, or you may be brand new to this business. In any case, we'd be glad to hear from you. Just give us a text and tell us what you thought. Thank you so much, and have a very, very blessed week.